Quite sure why this isn't working. Ah, there we go. Sorry, it just always takes such a long time to get the audio going. But listen, thank you very much for joining me and welcome to the week ahead for November the 11th. With me, Fiona Singota, Senior Market Analyst at City Index. So just a quick one before we have a look at the calendar, what we will be heading into. Let's just have a quick look at what's been going on this week. Obviously, a super key week as far as the markets are concerned. We saw record highs on US indices. We saw the US dollar rise and then fall away from a 4-month high. We saw gold tumble around $130. So, you know, lots going on. And basically that was on the back of Trump winning the US elections. What that could mean as far as the outlook for policy, as far as the inflationary outlook is. And obviously we had the Federal Reserve interest rate decision where the Fed cut rates by 25 basis points in line with expectations. Didn't really give too much away on forward guidance, just because obviously they don't, the Fed, and as they pointed out to, they don't necessarily know what Trump's policies will be implemented or to what extent, so they cannot play a guessing game. They will adjust policy as and when the data tells them they need to do so. So with that in mind, we're still expecting a rate cut in December, although outlook for rate cuts next year has been reined in to just down to, so we're expecting 2 rate cuts after the end of this year, so 1 in December and then 2 more heading into next year. So that's down quite considerably from where it was, just on those potential expectations that Trump's policies will be inflationary and could mean that the central bank is not able to cut rates as quickly as it was previously expected. So this is the Nasdaq. As we can see, it pushed up, broke out, hit new all-time highs. Let's just have a look also at the S&P. We'll just watch it there for a similar picture. Again, pushing up towards that 6,000 level, just within a breath of it. And then also on Wall Street, strong, oops a daisy, that wasn't meant to happen. Strong gains there, heading towards that 44,000 level. Just have a quick look at the dollar as well, what that's been doing against its major peers. A little bit of whipsaw action, ran into that trend line and has rebounded lower. Trades up across the week, obviously, despite the Fed rate cut. And let's just now move on with what we've got to look out for this week. So a relatively quiet start. And I mean, compared to what we've seen this week, I think it's fair to say that next week is relatively quiet as far as economic data is concerned. We've got UK unemployment changes, which interestingly comes on the back of the Bank of England interest rate decision, which we saw this week. We've seen that the Bank of England cut interest rates by 25 basis points. This was expected. But the central bank also warned over sticky inflation following the Labour government's budget, which is expected to be inflationary. And so the Bank of England went as far as to say they see it adding 0.5% to CPI at its peak next year. Obviously, that means that expectations for Bank of England rate cuts were lowered for next year. And also a December rate cut has been pretty much priced out. Was looking 70% priced in before the budget. Now it's just 15% chance of a rate cut in December, so pretty unlikely. So we've got the jobs data. I mean, obviously, if we do see some weakening in the jobs data, that is going to support the view that the Bank of England could cut rates, so probably not in December, but in early next year. Next rate decision, I do believe, is in February. So yeah, if we do get some weakening, because let's not forget that the Bank of England remains focused on service sector inflation, which is still a little bit sticky for the Bank of England's liking, even though headline inflation has fallen below 2% to 1.7%. Service sector inflation, wage growth were well above the 4.5% level. So they are still too sticky for the central bank's liking. So any signs of weakening in the labour market could just pull the pound lower. But to be fair, the pound looks pretty much set between these two levels at the moment. 128.50 on the downside is the level that we've been watching. On the upside, 130 is the level that buyers need to get across in order to bring this 130.50, which is the November high, into play. And a move above that will obviously help create a higher high, which will change the structure of this chart, which for the time being, the chart is a little bit more neutral. We're no longer building sort of lower lows as we had been across October. So the other thing to be looking out for is also US inflation data. Now, obviously, US inflation data is very much still in focus, but we've sort of heard that the Fed are pretty comfortable with the idea that inflation is cooling back to the 2% target that it was looking for. So, you know, and that we're expected to see continued falling. I think it was down at 2.4% in the previous reading. So again, inflation is going to be in focus. We've heard that the Fed have said that they will be data dependent. So, and we've got a 76% probability of the December rate cut being priced in. If we get cooling inflation data, that could increase rate cut expectations and just bring the US dollar under a little bit of pressure, which may just help the pound push above the 130 level towards that 130.50 level. But yeah, we'll just need to wait and see as far as that inflation level's concerned. We've already looked at the dollar. I'm just seeing if I don't think we've got much on the euro US dollar front. Just yeah, we've got GDP, but it's Q3. It's not preliminary. It's a repeat, so it doesn't tend to be as market moving. Same with UK GDP. So with that in mind, that means for euro US dollar, again, the biggest moving part here is likely to be US inflation data. Euro US dollar has had a bit of a topsy-turvy week. We've had this massive decline on the announcement of Trump's victory. Then we've had a small rally on the back, and then we've had a fall today. So really quite choppy trade that we've seen. And I think that's quite understandable given the different factors that the market is weighing up. So on the one hand, you've got those concerns surrounding the Trump coming to power and trade tariffs. He said that he will implement trade tariffs between 10% to 20% on US imports, on imports into the US, sorry, excluding China, obviously, where it's 60%. But given that the Eurozone, Europe has the largest trade deficit with the US, and that it's one of its largest trading partners, that does mean that Europe is in the firing line for trade tariffs. Now, we've seen that when Trump was in power in 2016 to 2020, and we saw that as the case. Obviously, growth in the Eurozone is very fragile at the moment. It's in a very different place to where it was in pre-COVID. So that could, you know, if we do see such moves from Trump, then that could obviously hurt fragile economic growth. Could mean that the ECB will need to cut interest rates faster in order to support the economy. Now, that's interesting because it's in complete contrast to the Federal Reserve, who may need to cut interest rates slower in order to deal with sort of slightly more inflationary policy from Trump, and also the resilience of the US economy. Let's talk about that for a moment. You know, data that we've seen from the US heading into the US elections has been broadly strong. Let's just not talk about the the US non-farm payrolls, which were really extraordinarily weak, but then that can be put down to quite a lot of one-offs due to strikes and hurricanes. So, I think, the markets are broadly looking through that figure, so is the Federal Reserve. So that's what we're seeing as the driving force there. And as a result, we've seen sort of this sort of big fall off in the euro US dollar as we heard out about Trump. Obviously, since then we had the Fed cut rates and perhaps sounded maybe a little bit more dovish than perhaps what the market was expecting, given what's expected from Trump. But as I said, the Fed isn't prepared to move on what's expected. It needs to wait to see what actually happens. So yeah, just as far as what to be watching, a bit of a messy chart really. Obviously, we've had this double top up there at 112, fallen down to just around the 108 level, recovered. This is this rising trend line that dates back to October 2023. Did fall down below there briefly. The long lower wick though suggests that the selling pressures at that level were quite weak. And we're back above that rising trend line for now, although it's just sort of looks like it's being tested. Now, that's at the 107.70. We're below the 200 SMA. We're below the 108 at the moment. So, if we do get a break below this rising trend line, then that's going to bring in 107 and then the 106.65, 106.70 level into focus, which was the low that we saw back in June. Should this trend line hold and we get a rise above 108, next levels we're watching out for, that's going to expose the 200 SMA at 108.70. If we can get above that, then things will start to look a little bit more positive. Obviously, we need a rise above 109.35 for a higher high. Also, whilst we're talking about US inflation, and what's going on there, great to always just have a look at what's going on in the Japanese yen. Again, a little bit of choppy trade this week after we saw the US dollar surge and then drop away. And basically we're still in this sort of upward trend though. We're managing to hold into this upward trend that's been in place since the September low. Come away from the high that we saw of 105.460. There have obviously been mentions on talk of intervention by Japanese authorities, which has just helped to strengthen the yen that little bit against the US dollar, pulling it away from those higher levels. But whilst it's above that 200 SMA, and we're still seeing a series of higher highs and higher lows, that means the uptrend is intact. The sellers would need to take out 151.60 in order to negate that uptrend, and then that would bring around the 150 level, round number, into play ahead of 148.10, which is the 38.2% fib level. On the upside, buyers are going to look to take out 154.70, and that brings 155 round number into play ahead of 157, which is the 78.6 fib level. So if we get stronger than expected inflation data next week, then that obviously is going to help boost the US dollar. But also we need to just bear in mind that we need to prepare ourselves for Trump's comments again. So if we think back to 2016 to 2020, Trump was no stranger from X, previously Twitter, and constantly making comments and remarks which was having an impact on the market. So it's something we just need to be bracing for next week as well. But I think in the meantime, Trump's not going to be inaugurated until the 20th of January, so it does give the market a little bit of time to focus on back on fundamentals and economic data and the Fed ahead of that time. So yeah, so that's USD Japanese yen. And also let's just have a look at what's going on in gold, because gold has fallen very sharply. Okay, here we go. So we had all-time high reached at the end of October 2790, so 2790, before the price fell sharply lower. Found support here on the 50 SMA, which is quite interesting. That's at 2650. 2650. It's been trading pretty much above the SMA since, well, for quite some time. I think it's fair to say we've been above the SMA for quite some time, back, you know, October, end of October last year, where it kept trading on it. So that's an important support to be looking out for. And I think that's the level that sellers will need to take out in order to extend that fall away from the all-time high. It's interesting because the picture with gold, I mean, if we think about it, US dollars have risen, inflationary pressures could be supportive, but the Fed's expected to cut interest rates at a slower pace. So the Fed cutting interest rates at a slower pace is supportive of the dollar. Gold is traded in US dollars, so that's going to keep a stronger dollar. It puts pressure on gold prices. So, you know, that's the logistics behind, the logic behind it, the fundamentals behind it. But let's not forget, looking out across 2025, when Trump comes into play, then, you know, there could be some concerns over geopolitical tensions, trade tariffs, which might find gold will give gold more support and safe haven flows. But I think for now, I mean, the rally is looking like it's running out of steam. The key level, as I said, on the downside is that 2650. At the moment, we're just staying above this support here, which is the 2685, which is the September high. A break below that is going to bring that 2650 back into play. I think if we get below 2650, then we'll be looking for the 2600, which was the October low. This is negating the uptrend. If we get a move below there, we're creating a lower low, which changes the structure of the chart. We could see a deeper sell-off. For whatever reason, if we find that 2650 does hold and we remain above 2685, then 2700, 2790 are the levels to be watching for fresh all-time highs. So that's what we've been looking for as far as data is concerned. We've also got German inflation, but that's just preliminary. Sorry, it's not preliminary, it's secondary. And we do have China data. And the other thing that we also have is China's Singles Day. So that's basically the Black Friday equivalent for e-commerce. And that's going to be on the 11th of November. That'll be really interesting because it'll give us a view of how consumption is holding up in China. I think there could be more of a shift towards, you know, value for money purchases and online shopping. But yeah, basically we want to see sort of, you know, some solid numbers coming through, particularly in terms of the stimulus measures that we've seen. Obviously, it's still very, very early days for that to be playing through, but we saw more stimulus announced today. As far as what we'll be watching, we've got inflation data, which is due out on Saturday morning. We'll be looking for 0.4% year on year, but the big data drop will be on Friday, where we've got the retail sales and industrial production. So though we're expecting to see retail sales come through a little bit stronger than previous, which will be encouraging. So let's just have a look at what's been going on. Oh, we've moved just back above it. We're staying within this there we go. Within these bands that we've sort of been looking at for a little bit of time now, 14,420 on the upside and on the downside 13,500. That's basically levels that we've seen from, well, we looked at this the other week, that we've seen from back in 2023 and also back That was at the beginning of 2023, January 2023. So they're levels to be watching out for. That's the 2023 high. So that's a pretty key level to be able to get above it. Obviously, upbeat data is going to help it higher. We've obviously had that stimulus optimism and disappointment, which is what's explained. Sorry, we have the trade data, which was better than expected yesterday, which helped lift it. And we've seen slight disappointment surrounding the additional $1.4 trillion stimulus announcement today, which has brought it back down. But so, I mean, data, as I said, next week, Singles Day figures are going to be very much in focus for clues over how the consumer's holding up. These are the levels that we're going to be watching out for. I mean, if you get a break below there, then obviously 13,000 on the downside will be the next one to be watching out for, ahead of the 200 SMA there at around 12,300. On the upside, get above that 14,400, and then we'll be looking towards the 15,000 level. Let's just have a look at the Hang Seng. Hong Kong 50, similar. We're seeing sort of, you know, pretty range bound. Since we've had that massive moves, it has been relatively range bound and as far as moves are concerned, which is surprising given the volatility and the moves that we've seen elsewhere. Obviously, with Trump coming into power, there is a little bit of concern over what that might mean for the outlook for Chinese growth and trade. So they're sort of risk factors which we're also looking to keep in mind. But so as far as levels to be watching out for, on the upside, 21,400, that seems to be the weekly high. It seems to be a level that we've seen middle of October as well. So that buyers are going to be looking to get above there, but we're neutral on the RSI as well. So we're pretty sort of neutral as far as movement this week has been concerned, and we're also neutral on the RSA. So that sort of tends to lend itself to a breakout. On the upside, then we'll be looking for 2,200. On the downside, if we can get below that 20,300 level, that's going to bring 20,000 into focus. And below there, we've got the SMAs coming into play. When looking at what's going on in China, it's also useful just to be considering the Aussie dollar, which again has had a really interesting week. We've seen this really big sell-off from that high that we saw in September. Failure at the 100 SMO, and it's just testing the 200 SMA right now. We've just got that disappointment, as I mentioned, surrounding the stimulus package. We had the strong trade data yesterday. There is a little bit of US dollar strength, so that's also sort of pushing the price lower. 200 SMA there at 66.20. Levels to watch on the downside. If we're going to break below that, then we could be looking at further weakness all the way down to potentially 65 if we see breaks below certain levels around the 65.50 level as well. On the upside, buyers are going to need to get above here, which is looking less likely, but it's a possibility. If we get a rise above the 67 level, which is 100 SMA, then we could look towards rises towards 68. And just finally, quick look at oil. Excellent. Okay, so here we go. This is oil. Again, pretty messy chart, and we've talked about this so much. Just looking around this 72.50 level and 71.50 resistance. Just as far as oil is concerned, it's just weighing up that Trump win, what it means. I mean, on the one hand, we know that Trump might, for example, apply sanctions, higher sanctions against Venezuela and Iran, which might mean that supply is more constrained, which would be supportive of the price. At the same time, if we get too much going on with as far as trade tariffs with China, that could raise concerns over the outlook or the demand outlook in China, especially as imports in China for oil have fallen quite significantly. So that just raises concerns over the demand outlook. Meanwhile, in the US, Trump is expected to be pro-growth. So, you know, there is optimism that we'd see higher growth levels in the US, which may help lift oil. And then at the same time, we've got OPEC Plus considering increasing output, which they were supposed to do in December, but they pushed it back potentially a month, they said, to see how the oil market holds up amidst soft demand and concerns over a supply glut. So, I mean, with all those factors, a lot that oil is weighing up. But as far as levels are concerned, it needs to get above 72.50 to really have any chance of looking up to the 75 level. Failure to get above this level here, you can see the price come back towards that 67.50 level, which is a level that we've talked about quite a bit on the downside as well. So excellent. That is a lot that we've managed to get through. And yeah, that's everything for this week. I hope you have a good weekend, and I look forward to seeing you next week.